While our central bank has signaled it's likely to be on hold for some time south of the border, the U.S. Federal Reserve is still in the midst of an easing cycle. So, can investors expect a rate cut at their next decision in just a few weeks? Joining us now to discuss that and his 2026 outlook, Gennady Goldberg, Managing Director and Head of U.S. Rate Strategy with TD Securities. Great to see you as always, Gennady.
Thanks for having me.
So this meeting, they're always interesting, but it's been getting very interesting just in the past couple of days. We got Fed governors talking about the potential for some rate cuts in December. The market last week didn't think it was going to happen. The market this week thinks it's going to happen. Where does your shop land on that?
So we still think a December cut happens, and the volatility in the pricing has been quite extreme, as you mentioned. We've, going into the October FOMC meeting, that December cut was about 24 basis points priced, basically almost 100%. Powell poured a little bit of cold water on it. There was no data in the midst of the government shutdown. Now, between kind of this drift higher in the unemployment rate, relatively contained inflation, and seemingly indications that we are going to get a rate cut here because some of the doves have spoken up. We do expect that December cut to occur. Heading into next year, though, things are a little bit less certain, and really, I think the Fed will be looking to be data dependent.
I believe you say Fed normalization and we're going to be the most important theme for 2026. So what does that mean for rates and that uncertainty you just mentioned?
So it really means kind of a very uncertain drift lower in interest rates. We're expecting the 10-year to finish the year at about 3.5%. We are expecting 3 more rate cuts next year from the FOMC. Now, those rate cuts are not going to be consecutive. They're not going to be, quite a bit in a row. We're expecting them to come on a quarterly basis in March, June, and September. They could certainly be a little bit delayed. I do think they'll be very data dependent. So if the data is not showing the need for rate cuts, the Fed could stay on hold for some time. But we do think ultimately they want to wind up at around 3%, which is where the majority of the committee expects neutral to be.
Now and then I'll be reading about, Fed policy and what the market is thinking, and someone throws quantitative easing back into the mix. What's your view on all that?
So, we're just ready to finish quantitative tightening. Starting in December 1st, the Fed is no longer letting the balance sheet run off. So at least that's one chapter closed. They're going to be reinvesting mortgage-backed security proceeds back into the Treasury market. What we're actually looking for starting next year is reserve management purchases. Now, that's going to walk, talk, and quack like QE, but it really isn't QE. We're expecting that more mostly at the front end of the Treasury curve. We're expecting that to be announced in January and probably starting in February. That'll be about 15 to 20 billion per month in Treasury bill purchases by the Federal Reserve. The markets are going to like that. It's not really removing duration from the market, but it is allowing the U.S. Treasury to fund shorter and thereby kind of implicitly keeping interest rates just a little bit lower. But keep in mind, this isn't QE. It is going to grow the balance sheet with the rate of the economy. So it's really not meant to be stimulative like QE was during COVID and during the Great Financial Crisis.
All right, important distinctions there. 2026, we should get a new Fed governor as well, a new Fed chair. Treasury Secretary is indicating we might even find out who that's going to be before Christmas. Reports out there, Hassett, the front runner. Does it matter really who actually becomes the Fed chair?
Very much so. I think right now, normally you would see anyone who's nominated be kind of quite credible, relatively committed to Fed independence. The question now is one of Fed independence. If it is, a chair Hassett, for example, the markets really are questioning the chair's ultimate willingness to keep the Fed independent from meddling by the Trump administration, by the Treasury Department. You saw the yield curve in the U.S. actually steepen quite dramatically after Hassett's name was announced as a potential front runner. And I think that's really on expectations that longer term inflation expectations could become a little bit more unhinged because Hassett is viewed as being kind of a dove, being very close to the administration, and potentially pushing for interest rates to move lower. Now, there is the rest of the committee to contend with. It's not just one person, but it is very important where, if you've got the chair of the FOMC trying to push rates lower, maybe where they shouldn't be, the markets could certainly take matters into their own hands and react poorly.
Now, when I think about the concerns that people have about all this policy, bond issuance, deficit levels, they're sort of on the side burner, but they are there. How could that play out next year?
Yeah, and it's interesting because earlier this year, it's all investors could talk about. It was issuance and deficits. We are still expecting deficits to remain quite high, 6% deficit to GDP. That's, out of a wartime period. That's basically unheard of. But you've got some pretty key points that I think are happening behind the scenes. And I think the Treasury is going to take some steps to try to keep interest rates lower. First and foremost, they're going to be issuing shorter on the curve. So they're going to be issuing more bills rather than longer dated coupon securities. They're also doing what's known as buybacks. So they're buying back some longer term debt, and they're ending up issuing a little bit shorter. And third, and I think most importantly, you've got the Federal Reserve, which will be active in the markets in terms of purchases. Now, they're going to go from one of the largest, basically, quote unquote, sellers of securities to now actually outright one of the largest buyers next year. So I think the supply demand dynamics actually look much more attractive and much more conducive to lower interest rates next year.
Before I let you go, I want to ask you about the U.S. dollar. We've had a lot of talk this year about devaluation, de-dollarization. But over the past couple of months, the U.S. buck's been pretty steady. What do you think of for 2026?
We're still expecting a little bit of downward pressure. I think as the Fed delivers those rate cuts, as they kind of feed through into markets, as they decrease the cost of hedging dollars, we do expect the dollar to remain a little bit under pressure. Our FX colleagues are expecting the dollar to fall by about 5 percentage points by the end of next year as well. So it's more of a gradual grind as kind of the sell America trade really turns into the hedge America trade in a more pronounced fashion.